Hi, it's Angela Torville and Mike Torville, your hosts of Get Moving, the real estate roadmap with the at-home team, where we're going to provide you with the education, tools, and unfiltered talk to keep you in the driver's seat. Thanks for joining.
Hello, everybody. We're back at Get Moving Podcast with my co-host, Angela Torville. I'm Mike Torville, the other co-host, and we also have a guest today, as usual. Our guest today is Arnie Magid. Arnie is a co-owner of Cassidy Financial. Welcome to our show, Arnie.
Thank you very much. Glad to be here. Thank you for having me.
Yeah, I'm glad. We've become not just a client, but friends.
Yes.
And we've got to know each other over the years, got comfortable working with each other. I'm a client of yours. Mm-hmm. And so we certainly have recognized over time the importance of financial consulting, especially when it comes to mortgages, mm-hmm. especially when you have to think about your liabilities, your debts, and how that affects mm-hmm. your assets and the growth of your assets mm-hmm. and the impact that each has on each other. There's so much that we could talk about, and I think we always say in our book, Get Moving, the importance of using a financial consultant, I say consultant, advisor, mm-hmm. When considering a mortgage, because you may not be aware of the impact that your liabilities have, your mm-hmm. mortgage has on your ability for your asset growth and your retirement and so on. There's so much to it. Mm-hmm. You've been in the financial advisory field for how long now?
Oh, close to 30 years.
30 years? Yeah. Wow. Did you decide to do this when you were a kid?
No, I came through a different pathway, different businesses I was into prior to entering this field. And I realized that when I was entering this field about 30 years ago, I wasn't getting the kind of advice that I thought I needed. So I said to myself, well, I'm just going to figure this out on my own. And one thing led to another. I decided to get into the business full time.
Okay.
So going from sort of self-identifying what are the things that I need to do for my own finances, and it seemed to me that everybody I talked to had similar questions. How to deal with money, how to deal with mortgages, how to deal with debt, how to deal with investments, how to think about retiring. And most of the people I was talking to weren't getting the answers they were needing from their sources. So I thought to myself, well, I'm going through the same process. I've resolved some of these things, and I think I can help a lot of these people. And one thing led to another, and here we are.
30 years later.
Yeah, right.
What did you do before?
I was in the medical field, selling medical equipment and doing some consulting for medical facilities.
Any regrets of changing your career?
No, this has been great. It's very fulfilling. You start to feel like you're part of people's families. Right. You're part of their lives. Now going on sometimes third generations of people that I've been dealing with, the grandchildren of my original clients, mm-hmm. As they get into their 20s and 30s.
Yeah,
it's a gift. That's a gift,
yeah.
To get to know people like that and start with, just a servant heart,
yeah.
And you are. I mean, you met with me when I was in my early 20s, I think,
yes.
and you sort of blew my mind a little bit, with some tax things we talked about. Yeah, like it's...
You start to get invited to weddings and funerals and other kinds of events.
Yeah.
And you see the whole life cycle of people coming and going from their early careers and planning for retirement. And probably the most rewarding thing is when people are retired in their late 60s, early 70s, and they come back to me and say, I don't think this would have been possible unless we started planning this and putting the building blocks in place 20 years earlier. Mm-hmm. Otherwise, most people will sort of flail around and sort of land where they land without much guidance, without much planning, and they may not land where they want to land.
If they leave it to chance like that,
right.
Yeah,
it's a bit like driving to San Francisco from here, as I like to say. If I said, okay, I want you to get in your car and drive to San Francisco this afternoon, what do you do? And I had one person reply to me that, well, I think I can get to Pittsburgh pretty clearly. I'll get on the Mass Pike and just kind of go west, and I'll get to Pittsburgh pretty easily. But between Pittsburgh and San Francisco, it's a long way with a lot of opportunities to make mistakes and make wrong turns. So in the short run, you can probably iron out your finances for 90 days, a year or so without somebody like me. But if you're looking for long-term planning to get from Pittsburgh to San Francisco, that's a much longer pathway that probably needs a little bit more of a map. And we try to create a bit more of a mapping process.
During that trip, that journey, okay, the one to Pittsburgh and then the one to San Francisco, with your life, it's a short term, couple of years, 10 years, 15, 20 years. The funny thing is about that, during those 20 years, during that complete voyage, lots of things change.
Yes.
You grow up, you have kids,
Yep.
your financial needs change, college, marriage, and all of those things that alter the initial course.
Multiple homes, multiple mortgages.
Yeah.
Okay.
Yeah.
And multiple jobs.
So the initial course might be straight west, but then you say, wait a minute, we had to go this because we had 3 kids, and now we have 3 college.
Yep. We had a flat tire. We had to get a bigger car. We're not going fast enough. We ran out of gas. I took the wrong turn.
Yeah.
All these things happen. So, as I like to say, the further out you go, the more planning you need to do. The inverse of that is, when we talk about investing, the shorter the period of time that we're working with, the harder it is to predict anything. So what's going to happen in the investing world or Wall Street or whatever in the next 90 days, 6 months, it's really hard to say. But the longer you look out, the more things average out. It's sort of the opposite of life planning. The longer you look out, the more planning you need to do.
Well, right. You're right. If you look long term, you can see the trends. You can have some expectations of what's going to happen.
The trend in history is sort of on your side in investing, but when it comes to your personal finances, looking forward, it's too easy to get off track or not even have a track to start with.
Right.
Okay.
Most, I think, don't have tracks to start with. Yeah.
And a lot of people will have good incomes, and they do what I call sort of living off the cash flow. And I think one of the more important things that people should be doing, and very few people do it until they're retired or if they're lower income. But if you make good income, nobody makes a budget until they're forced to. It's sort of like cleaning the garage or cleaning out your grandmother's attic. Nobody does it until they're forced to do it.
They don't think they need it.
They don't think they need it. They're living on cash flow. Everything's fine, and we're doing great. And I have more money at the end of the month than I thought I would, so everything's great. But it's sort of like the map. Unless I have a map, I might not get from Pittsburgh to the West Coast correctly. And I think with a budget, people can plan more effectively. They can effectively plan, can I afford the next mortgage? Can I afford to upgrade my home or get a larger home, go from the starter to the second home? With a budget, they can think about, am I putting enough in my 401k? And how does that play into the mortgage? If I get a bigger mortgage to get a bigger house, does that impact my ability to put money into my 401k? Because it's a cash flow movement. Where should I direct my cash every month? And what's the most optimal way to do this?
That's where I feel like I see in my practice consumers fall flat is because the leftovers, there's no plan for the leftovers.
Right.
Everyone knows what's due when. But that chunk that's left, if they have it, they just spend it.
Right.
You know, they're getting marketed to daily and
Yes.
want to live a lifestyle and not thinking about when that income stops, you know, at the end of the map.
and when people stop and say to me, because it's always a variation of the same question, how much do I need to accumulate in order to retire? How quickly can I get to that point? How much do I have to put away to retire? How much will I gain per year? What kind of rates of return can I expect? And when can I retire? All variations on the same thing. How do I look at things when I'm, say, 65-ish? And will I be ready is really the question. Will I be ready? And how do I get ready? And I think the first thing you do is establish a budget, establish a savings plan, put your 401k into action. A lot of people don't put as much in their 401k as they could or should. And then the question is, how do they balance that against the cash flow needs of an active family, the current mortgage situation? And we have the conversation with folks about mortgages in general or debt in general. And you folks probably hear this all the time. People come to you and say, oh, I grew up in a family that taught me debt is bad. Don't owe anybody any money. I don't want any debt hanging over my head. And, that's all well and good if you're not able to manage your finances, because then it gets out of control. So to me, debt is merely a tool to get you from A to B. A mortgage is merely a tool to get you from A to B. And can we manage it effectively is the question. In the prior years, up until about 4 or 5 years ago, you had very low interest rates. So to get a mortgage at 2, 3, 4% was a wonderful thing. People would give their right arm to get a 3% mortgage today.
Yes.
And I've heard people say things like, well, I'm worried about this in the world, I'm worried about that in the politics, international strife, whatever the case might be, and I want to be more safe. So I want to take money out of my retirement account to pay off my mortgage at 3%. And it's one of the most disastrous things a person can do is take money out of a retirement account, pay the taxes, and then pay off a cheap mortgage.
Right.
Right.
It's financial suicide.
It's like a mental thing. I got to get rid of that debt.
I got to get rid of the debt.
Yeah.
So I'm safe, right? My
Whereas
housing
if
is
you're-
secure.
If you're at least creating an ARP, in other words, if your return is greater than the cost of your
Right.
mortgage, if you're paying 3%
Right.
and you're earning 6%, well, then why would you do that?
Well, exactly.
Yeah.
And I make a silly analogy to people. I'll say, if you went to a bank down the street and borrowed $100,000 at 4%, and you took the $100,000 and went to a second bank a mile down the road and could get a 6% CD if they existed, would you do that? And people look at you and say, well, of course I would. I borrow at 2%. Cost me $2,000 a year in interest on a $100,000 loan, and I can earn $6,000 on a CD down the street. Why wouldn't I do that?
Right.
And then I try to expand that analogy to exactly what you said, Mike, and that is, over time, we typically earn rates of return that exceed mortgage rates and exceed CD rates over time, long-term averages. But people are oftentimes very short-term oriented in their financial
and
thinking.
that brings up something. There's a couple parts of this. Going back to the budget, which will go right back to what we're talking about right now, is because at the very least, a budget creates an awareness.
Yes.
You see what you're spending,
Right.
okay? Whether you follow the budget or not, at least you have that in front of you to say, wow.
Yep.
And an example might be, gee, I can't afford to put an extra $500 into my savings or into my retirement. I
Right.
just can't afford it. But then when they look at the budget and they see they went out to dinner 6 times that month,
Right.
and each time was $150, and
Right.
they go, I can't believe we spent $900 to go out to dinner
Yes.
that month.
Yes.
Yet I can't afford a $500
Yes.
contribution. Wait a second, let me rethink this. So the awareness, I think, would help that. And if you're looking at that extra money too, and I'm segueing back into what we were just talking about, is, gee, let's pay extra on our mortgage. And that might be fine if their goal is to get that down quicker. But what if instead of paying $500 on their mortgage at 2, 3, 4%, they put it in their retirement account, and yet they're earning more to enable the quicker payoff than as
Exactly.
if they put it at $500.
So you think about that. I have a lot of people saying, I don't want any debt. I want to get rid of my debt. I want to pay off my mortgage faster. And there are ways to do that, which you and I know about, we can talk about. But if you have a 3% mortgage, and many people have under 4% today, if you have a 3 or 4% mortgage and you're putting down another $500 a month, what's really happening here? Number one, you're saving 3% on that money. However, you could be getting a 20% savings on that money just on the tax deduction on the 401k out of your payroll.
Right.
Not even including a potential rate of gain in the 401k, and not including an employer match quite likely in your 401k. So I tell people who have low interest mortgages, it's very rarely a good idea to pay extra on a 3% mortgage. You're much better off taking that money out of your paycheck, pushing that extra couple $100 into the 401k. You get an immediate close to 20% savings in taxes between the federal and the state tax rates, maybe greater than that if you're higher income. And you have the chance of earning money on the 401k at likely a greater rate than the mortgage is costing you. So I think it's one of the most difficult things for people to get their heads around. I got to get rid of the debt.
It's just up here.
But to me, it's managing the cash flow versus getting rid of the debt. So I kid around with people and I said, if you guys could get me a mortgage at 3%, I'd borrow $1 million for 100 years, and I would die with it.
Right.
And people look at me like, well, what kind of a statement is that? And I say, it's no sin to retire with a mortgage or die with a mortgage, as long as the cash flow supports it and your lifestyle is working along that cash flow. If you can't afford it, you can't afford it. But people think they have to get rid of their mortgage by the time they're retired, and it is simply not necessary. In their minds, they may have been taught to get rid of that mortgage. But if the cash flow supports it, they have enough 401k savings, their budget works, and it's really a matter of when you're retired or getting close to retirement 2-3 years out, that's the most critical time to do a budget. How am I doing now? What are my expenses now? Will they be the same when I'm retired? And can I afford to buy a bigger house when I'm 63 years old because I want to, or I want to buy a second home and I take another mortgage? And can we make the cash flow work? And you just have to do the arithmetic.
Right.
Until you do the arithmetic, you really don't know. So it becomes sort of emotion versus mathematics. And the mathematics will paint a clear picture, and then you can decide whether you really want to do it or not with sound mathematics behind you, rather than just having your gut feelings drive the decision.
Right.
Yeah, you may say, oh, I'm debt free, I don't have a mortgage anymore. Boy, do I feel good.
And you know what they say,
But,
Mike?
yeah.
They say that, well, they can't take my house as long as I pay my taxes if I don't have a mortgage. I mean, this is a notion and a conversation that comes right out of the 40s and 50s, or even going back to the Great Depression. And so what happens if you have a mortgage and you're retired, and you start to get up in years, 75, 80 years old, and you still owe a couple $100,000 on your mortgage? Well, unless your kids are going to actually move into that house, what's really going to happen?
Right.
If the home is worth $700,000 when you die, and you owe $200,000 or $300,000. And if you don't expect your kids to move into that house because one lives in Chicago and one lives in Florida, what's really going to happen? They're going to sell the house, pay off the mortgage, split the proceeds, and call it a day. And
Still a win.
and everybody's fine with that.
Yeah.
So it allows you, Mr. and Mrs. Smith, to live the lifestyle you would like while you're in retirement, rather than forcing yourself to pay down the mortgage as long as you have enough money to meet the cash flow between Social Security, maybe a pension. A lot of people don't have pensions. Private savings, and 401k distributions. If we can make the math work, then we can have the lifestyle and the mortgage without it being an overhang on your worries.
Yeah. Yeah. And I think when it comes, even in the beginning, prior to the retirement age and thinking about selling, in the beginning, when people are considering, maybe they're in their 30s, or
Right.
I guess what's happening now is the average first-time home buyer age has been increasing. Now it's in the 40s.
Yep.
Is that correct?
I think it's about there.
Yeah.
In
Yeah.
the 40s, but it used to be in the late
In the
20s.
40s, getting down payment
Yes.
assistance
Yeah.
too,
Oh,
because
Right.
they
the-
haven't put a budget
Yes,
together to
yes.
save the funds
That's a higher
or think
age,
of
but
retirement.
if you're younger
yeah.
than retirement age and you're thinking about your first mortgage or second home, either way, oh, hey, listen, we can afford a 15-year mortgage. Let's do this, pay it off real
Right.
quick. And it might be suitable for certain
Right.
people. But yet, I think it's important to pause and say, let's just get some advice and see how this affects our longer and short term,
Right.
and consult
Right.
with a financial
Right.
advisor.
Well, we have a lot of things going on now that have sort of clouded the picture in the past couple of years. In 2022, we saw interest rates jump through the roof because of inflationary concerns. And while interest rates have come down from 8% mortgages a couple of years ago to 6.4 today, something like
Yep,
that,
yep.
that's still not low enough for some people to make the monthly payment. At the same time, housing prices have gone up dramatically. And especially, I read an article recently that Hartford County has been one of the
Connecticut's-
strongest
yes.
markets for housing prices in the past 3-4 years.
In the country.
And,
yeah.
and it's been, so housing prices are rising, and mortgage rates have come down a bit. I do expect interest rates to continue to come down in the next year or so.
Okay, I like that.
At what rate is hard to say.
Yeah.
But I think the trend is on a downward trend, although there's a lot of debate about that, especially
In the
past
short
couple of
term,
months.
yeah, happening. Yes.
In the short term, we have fluctuation, but the trend is downwards, which only benefits the consumer and benefits the home buyer. So you have a lot of people that can't afford the first-time home because prices have gone up, and the monthly payment is higher now than it would have been if it was a 3% mortgage
yeah.
a couple of years ago. But I expect that to improve somewhat in the next year or two. So you're right. People are delaying. They're getting personal assistance from their families. They're
Yeah,
they're
all
borrowing.
kinds,
They're
yeah.
borrowing money from other places.
I'm finding money, lots
right.
of places. Right now, just they're doing $25,000 in Massachusetts with
right.
0% rate deferred payments, meaning no monthly payment to help people get in. That goes
Yep.
till July 31st. But yeah, I was going to say I have a scenario, and I'd like to see if I gave the right advice. So I have a client looking to buy. He's in his 40s, late 40s, self-managing his own investments, about $100,000 in there. Not retirement, just investments, and he's buying a home. And his message to me was, I want 20 down and I want to pay this thing off as soon as possible. The rate's about 6%. And he said he's gaining around 10 with his funds. So I said, well, if you don't have a financial planner, we can have a conversation with one, but I'm going to show you 20, 15, and 10% down because we speak to payment, affordability, flow of money monthly.
It's like buying a car. What's the monthly cost?
Right, the monthly, not necessarily the rate so much, but where he's liquidating from was the concern of where, rate, return, payout, and then he can afford the payment on each down payment selection. So, defer him to his account, basically, to see what his gain is. But if he's gaining 10 and going to pay 6 on a mortgage... what would be...
You have roughly a 4% spread there.
Right.
The trick with that is it's not like borrowing money from here and putting it into a CD with a guaranteed rate of return.
Right.
The rate of return is going to vary. And over time, people usually, if they have a balanced portfolio without taking absurd risks and without being too conservative, will have a decent rate of return in most cases over 3, 5, 10-year periods. In the short run, we have all kinds of fluctuation. So people get concerned that the rate of return in their investments is not guaranteed, and therefore they feel like they can't rely on it. Over time, most investors that work with someone like myself or have put together a balanced portfolio on their own will have decent returns. Most of the time they will exceed the mortgage interest rate. But I think nowadays, what do you folks see as the average holding time for a home? 5, 7 years typically in many cases?
I would say between 5 and 10. Right now a little longer with those rate locked people, but
a lot of people are trapped in their first starter home.
They're making those work somehow.
Because they can't go from a 3% mortgage to a 6.5% mortgage to get to the second home. But in the short run,
5 to 10.
You folks may be seeing adjustable rates for the first 5 to 7 years. That might be more better than a 30-year conventional loan.
Sometimes,
and that might be a good way to start for someone like that.
Okay.
The other thing besides a person's investments, how much do they have in the bank?
Probably about 30 grand liquid.
And a lot of times people keep too much in the bank because they think, well, what if something bad happens?
Right. I need 6 to 8 months of expenses in this bank.
If I lose my job, if there's 2 incomes and one person loses their income, you may not lose your home.
Right.
But what if the roof flies off the house or something crazy happens? Well, there's insurance for the roof in case we have a hurricane. So I think a lot of people are too conservative most of the time, are hoarding too much cash most of the time, and need to work on a budget which will help guide them as to how much cash they should keep versus how much they feel they need to keep just to sleep at night. So the sleep at night number may be different than the actual number that you really need to have in place to make sure things are okay. So I find people, especially when we see a lot of concerns what's going on out in the world, will tend to hoard more cash than they need to and be too afraid of investing, which is rarely a good idea.
Yeah, so what I heard you say is a lot of emotional conversation you're having around this. So this isn't something, back to that client, he's self-managing online. So I don't care what AA bot you got. They're probably not asking those emotional questions that matter with lifestyle and personal goals, So
I think that debt becomes an emotional issue for many people. And investing becomes an emotional issue for very people. And too many people are looking at the short run. How much does that stock go up in the last 2 weeks?
Yeah, they're watching it daily.
They're watching it daily. I think one of the worst things people can do is watch their investments daily.
Right.
And so many people do it. And I think looking at your investments daily gives you either a false sense of joy or a false sense of dismay, because investing is a long-term process. It's not 3 days. It's not 3 months. It's 3 years or more. And people will ask me, how often should I look at my investments? I want online access. I want to see it every day. And I say, well, I think when you get your quarterly statement, that's enough. So looking at it 4 times a year is plenty. And they look at me like I've just made a blasphemous comment. How dare you suggest I don't look at my investments at least 3 or 4 times a week?
It can be stressful if you check it out every day.
Or are you trying to do something short term?
Yes,
that would make you have to pay that.
So then people will say, what if I see something I don't like and I have to make a change? Well, how will you know? Well, look at what just happened a month ago where we had this Middle East flare up. Market went down. Some people wanted to get out. But if they had gotten out, they would have missed the last 2-3 weeks tremendous rebound. And so people are far too concerned about short-term market swings and short-term market timing to shift their focus to the long run. And the long run doesn't have to be 30 years, but the long run is not 30 days.
When you have that reactionary withdrawal,
Right.
to all you're doing is locking in your losses.
Exactly.
Right.
And people such as Warren Buffett over the years have, I'm going to paraphrase probably badly, but a person like a Warren Buffett, a seasoned investor, is quoted as saying something along these lines. People sell their stocks when they buy them at 100 and they go down to 90 or 80. And who buys them? I buy them.
Yep.
I buy them
I
at
buy
80.
that 80.
And a few years down the road, when they've gone back to 90, 100, and 110, I become very wealthy. And those people are still sitting with their $80 in a CD, and maybe they might have 85, and I've got 110 some years down the road on this portfolio.
That sums it up. Yeah.
And so people always sell their stocks after they have gone down.
Always out of fear.
It's all out
It's
of
just
fear.
fear, yeah.
And the two worst things you can do as an investor, the two enemies of investing, is market timing. What should I do now because something is troubling me or concerning me? And number two, selling after stocks have gone down, because then you miss the rebound.
Right.
And we've never failed to have rebounds.
I was going to say the charting, the swings, there's history
right.
there, there's hindsight, and that still
You-
always applies.
You,
I'm sorry.
you look at the charts, and I tell people in most cases, past 15, 20 years, stock market rebounds have occurred much faster than anyone wishes to believe. And I'll say that again. Market rebounds happen far faster than people wish to or want to believe. And when you look at the charts, you see that's fairly common. Even in the great market drop of 2008, a couple of years later, we were back to even. You look at 2022, and the market went down 20%. A year later, we were back to even. And you look at the COVID time, 6 years ago, stock market went down 33% in a month, in the month of March of 2020. 33% is very scary.
Yeah, that's a lot. That's a huge
By the
dip.
4th of July that year, just about all of it was back a mere 4 months later. And people couldn't believe it. But I think the economy is far stronger than people give it credit for. People are too tied up with the fear of international issues, politics, concerned about debt. Fear should not be driving your decisions. Planning should be driving your decisions.
Right.
I think that's the
clearness.
difference.
Yeah, clear drive.
And I think people are looking at their debt and their investments in two separate silos, right? And it's easy for us to say right here, but if somebody is considering even the simplest choices in a mortgage, should I take a 15 or a 30?
Right.
Should I take this rate with points or this rate without points? What? Me and my wife will discuss it. We'll come up with an answer. And I like to say, just pause for a second, and maybe it's smart to consult with a financial advisor just to get the fuller picture, long term and short term. And maybe there's something they didn't realize. Maybe you'll confirm their choice to say, that 30-year fixed is exactly right for you. But it's better to go to that sleep at night numbers, and they can say, okay, we made a good decision, and it's been confirmed by a professional, and maybe this makes sense for us after all. Oh, we didn't think, and we were set on getting that 15-year mortgage. But you know what? This 30-year gives us that flexibility, gives us that option, and there's maybe some aspects of this that they didn't think of, and I think that's what's overlooked sometimes.
Yes, I think it's fear of the unknown, fear of having any debt whatsoever.
There's a profile right now that's very prevalent, and it's the 2 to 3% interest rate mortgage holders with lots of equity because we had a 20% gain since COVID, right, with values. But they have a lot of consumer debt, and they're drowning with that monthly cash flow.
Right.
So, people would be, historically and conditioning, of that people have with their finances are, I'm just going to dig through this, right? But they have this huge chunk of equity, maybe a smaller rate. Is that a profile possibly that you would say, maybe a refinance or a second lien even to wrap up?
Home equity line of credit. And I think as we get further down the pathway here, it might make sense for people to look at, and you guys are the experts, going back to the
ARM.
the adjustable rate.
The ARM,
Go to the ARMs and maybe refinance for 5 or 7 years and roll that the credit card debt into that.
Yeah.
And yes, that might be a higher interest rate. You might be at 5.5 or 6 instead
Overall,
of back to your 3 or 4% mortgage. But if you've got credit card debt, and the credit card companies are charging you 20, 25% interest, that's a killer.
Yeah.
So I'd much rather
Yes.
refinance and put everything into a 5-6% arm than continue paying my
30%.
credit card
And then
bills.
you can advance the payoffs
Well,
to get it done earlier.
you know,
yeah.
so when I'm dealing with that, or they're selling and buying, right? I have a client right now. It's $30,000 in just credit cards. They're saving $1,000 a month once we get those paid off in minimal payments.
Right.
Now they're selling and buying, but if we were looking at refinancing, we wouldn't just let that money be free money to their budget, right? Let's reallocate it.
Right, and that's where we get back to working on a budget, working on a cash flow plan, how much comes in, where are you spending it, and how do we consider moving the chess pieces around? You mentioned going out to dinner, and
DoorDash.
we and DoorDash.
That's the one.
But actually, DoorDash might be better than going to dinner. And I had a person say to me, must be 15, 20 years ago. They went out to dinner 4 or 5 nights a week in West Hartford. Very nice restaurants, and they told me how much they're spending in a typical week, and it was a fairly high number even 15, 20 years ago. And they said, we need more money. What should we do? And I said, well, is it possible that we don't go out to dinner as much? Well, I don't cook. Okay, fine, go out to dinner, but can you consider the following options? Perhaps not having a drink for starters, not having an appetizer, perhaps having a very nice entree, no dessert, no after dinner drink, and no coffee. And maybe that $130 tab becomes $65, and then you leave a tip on a smaller number, no disrespect to people living on tips. But although those tips are not being taxed anymore, thank goodness, can you trim down the average meal when you go out to dinner by a bit, by not having two glasses of wine and dessert and all the other things, and still have a nice meal to enjoy without cooking?
Right.
And that person was appalled by that suggestion. So
Well, that's their lifestyle.
You can't save
change them all. But I mean, just to hear a financial planner that's been doing this for 30 years have a conversation like that with a client as far as how to trim down and budget eating out, right? So it goes so much deeper than I just think a lot of consumers they just think that you just are they need $100,000 to talk to you, and that's it, and you're going to pay a bunch of money to manage it. But you do so much more.
They really don't. I mean, a lot of the time that we take with people, we spend a lot more time in consulting and conversing about budgets, the world around us, political international topics, interest rates. A lot more time goes into that than actually in picking the investments.
Right.
Because people need a lot of discussion, because unfortunately many investors and home buyers are driven by fear of loss or fear of making the wrong decision versus opportunity.
Right.
Okay. And the Wall Street old grizzled veterans will tell you that people are more motivated by fear than gain.
Oh yeah.
Okay.
Oh yeah. Look at our media today.
Yes.
Right. Well,
There you go.
And the media, whether it's the political media or the financial media, makes people think about things in a certain way that really drives them to making fear-based decisions and worry-based decisions versus looking at the actual economics or the actual arithmetic that's facing them.
Yes, the facts of it, not the emotion.
People go through their lives, and I'm myself included, go through their daily lives. And for example, let's say you say, okay, you want to go on a diet, you want to lose some weight, or your doctor says, yeah, you're getting a little chubby there. Why don't you keep a food log and see what you're eating every single day? I got food log with that. When you start writing down everything you eat, you're astounded. Like, oh my gosh, I can't believe I keep eating those snacks. I keep drinking this thing.
Right.
I wasn't aware.
Or you go, I'm not going to write this one down, so I'm not going to eat it. I'm embarrassed.
Until I see it and it's in front of me, and I'm like, oh my gosh, wow.
Yeah,
Same thing with your
it's true.
money.
Right.
It's
Yes,
the exact
what
same
you
thing.
focus on,
but
you
what
can
you spend every
change.
day is like what you eat every day.
Yep.
And you might get creating the awareness first, right? And once you see it, like the couple going out to dinner, and say, I can't believe it was this much money. And then you can start to say, I see it in black and white. I got to do something different.
And when you get down to real nitty-gritty stuff, and people are really getting into the details of that level of budget analysis, you start to say to people, every decision you make that's discretionary should be thought about twice. You're standing in the checkout line at the grocery store. Do I buy that magazine and that candy bar as I'm waiting in line or not? And a lot of people just grab what they want and carry on. And many people can simply afford to do it. It's not a big deal. But if you're at any point concerned about your budget, every discretionary item should be considered on a day-to-day basis. And I can't follow you around all day as you go through a grocery store or go through a shopping mall. But do I really need that second pair of sneakers today? Do I really need to buy that magazine today? Do I really need to order dessert and a cup of coffee or an after-dinner digestif after dinner?
Right.
And can I save, if I go out to dinner a lot, can I save $100 a week by trimming that down? If I'm going shopping for my kids, do they need 3 pair of sneakers or 2 pair of sneakers?
Right.
So it's sort of a nickel and dime kind of approach, but if you think about every discretionary purchase that you make with the idea of, okay, how desperately do I need to do this? Will I die if I don't buy it?
Right.
How distraught will I be if I don't buy it? And can I live without it?
And if you were to illustrate, what would that $100 or $500 a month do for me at the end of a year, at the 5 years? What might that look like?
Well, $500 a month is $6,000 a year. That could go into your 401k if you're not maximizing it, and you could save perhaps 20% on taxes on the $6,000 right off the bat, plus getting a company match and long-term growth on top of that.
And what
All I'm
happens-
hearing is $12,000, $15,000 at that
Right,
point,
right,
right?
right,
If we had a company match out of $500.
Once it's out of your paycheck, you don't notice it as much. At first, it's a little bit of a bite, but after a while, it becomes okay. That's what I have.
Yeah, for your retirement.
And
But
just-
being
yeah.
intentional with spending, I always, as a mom of 4,
Right.
I don't care if I make $1 million or 20.
Right.
I have my budget set, and my kids have been
Right.
built like that too, so they know this
Yeah.
is the budget, and this is all I'm going to spend. So I can spend it on whatever I want. So you don't have to be so granular with the want, but more of the limit, right? And that's
Yep.
you can
You
still
just-
spend,
you just-
have
you
fun,
just
but have
to
a
be-
limit.
You have to be paying attention to your daily activities.
Right.
Yeah.
Before we run out of time, I want to
Yeah.
toss in one more notion here,
Yeah.
and that is if I'm getting my first mortgage of $500,000, or if I'm getting my second one and it's $800,000 or more. When people get a mortgage, they have to think about what are the implications of, how should I say, disaster planning, which leads me to suggest to most people, when you get your first mortgage or go to the next one and you get the bigger house, do you have life insurance? And if you do, should it be evaluated by someone that does what I do and saying, is this enough for my family to be okay in case something happens to me or my spouse? What are the implications of this? Do we need life insurance? Do we need to review what we own and either replace or add to it, get another policy? Do I have too much? Do I have the right kind? Because there's several
Right.
different flavors of life insurance. So I think, taking on a mortgage of $800,000 or $300,000 makes one consider the what if. And if you have the what if covered with some sort of life insurance, and the needs vary and the types and the styles vary, it's a worthwhile conversation to have. How do I protect my family in the event of? And I have an example of a lady in Connecticut, youngish, 40-ish, lost her husband a couple of years ago, got a $600,000 life insurance policy, and was concerned about the mortgage, which was about $500,000. And we decided that we were going to invest the money because we believed that she could manage on her own job's cash flow. She could make the mortgage payment and didn't need to pay off what was at that point a 3.5% mortgage
Oh, yeah.
and take $600,000 and pay that off versus let's invest it. And if her cash flow supported her lifestyle, she didn't need to throw away the future gains on investing. And here we are a couple of years down the road, and thank goodness the investment environment has done well. So she's made more than the 3.5% mortgage that
Right.
she's been carrying.
Yes.
And we also have a backup plan where we could start sending her some money out of this investment to help pay the mortgage every month in case her income doesn't sustain itself. But so far it has. So
Beautiful.
when someone passes away, and this one spouse passes away, the instinct is, I got to get rid of my debt. I
Well,
gotta
that's
pay
what
off
you
the
got it
mortgage.
for.
Right.
That's what you got the policy
And
for,
we got the
right?
policy to do that. But
Yeah.
if the policy is enough and your second income, surviving income is enough, you might not need to take a large chunk of money and evaporate it on a very low cost mortgage.
Right.
If her mortgage was 8%, we might think differently about this.
Correct. Yeah.
But it was 3.5% with a manageable payment based on her actual salary. So
Okay,
she could
for
afford to keep
conservative,
the
yep.
mortgage at a very low interest rate for a long, long time. and not, give up this investment. They call this opportunity cost in Economics 101. You take money here and you put it there and save a little bit or earn a little bit, but forego a better rate of return if you're long-term oriented.
Mm-hmm.
So you lose the opportunity for gain if you're too fearful or if you haven't done a budget.
Right.
And
You just don't know.
she and I
Yeah.
did a budget together, and we could see that the math worked, and she didn't need to use the money to pay off the mortgage. It was more of an emotional thing. I
Right.
want that off my back. I don't want to go to bed at night worrying about a mortgage. And she didn't have to, but we could earn enough money off the investment that we could help make that payment if we needed to.
Yeah, now she has more income sources from it.
And
Yeah.
it goes back to the basics. And a lot of people, going back to this phrase, people don't know what they don't know.
Yes.
And when they see, okay, wow, I wasn't aware of that choice. I wasn't aware that that was an option. I didn't think of that path
Right.
versus. And so I think that, and to emphasize, I've said it a few times, it's really important, even when you think it's the simplest of decisions. I'm just going to get a 30-year mortgage, and that's what I'm going to get.
Right.
Or I'm going to just get the 15 because that's what I'm set on.
Yep.
To speak with somebody like yourself, speak with your financial advisor and say, here's what I'm thinking about. Is there any implications in terms of my retirement funding? Or what's this going to look like? Am I making the right decision? What options should I consider? Simple, but don't just take for granted and make the assumption you know all you need to know before consulting.
There's no substitute for doing the arithmetic.
Right.
And working on a budget, no matter what your age.
And what
And
could
you
I
might,
do? Yeah.
well, you might not like to do the arithmetic, but Arnie, you love it, don't you?
Well, yeah, I mean, we're sort of used to it.
Yeah.
That's part of what we do. Or
Yeah.
anybody that does what I do
Yeah.
should be able to take the time and sit with a client
Yeah.
and walk through the math and say, this is what we should be doing, and how do we move the pieces around on the chessboard
Yeah.
to optimize the situation? Because every situation is a little different.
Right, right. Well, how can someone get a hold of you, Arnie,
Well, yeah.
to connect and have that work
well,
done?
probably the quickest way to reach me would be simply to call our office.
Okay.
It's area code 860 in Connecticut, in East Windsor, Connecticut is where we have our office, Cassidy Financial, 860-623-0104.
Great.
Ask for myself or my business partner, Brian Cassidy. Would be happy to help people. We work with folks in 22 states, every New England state, and a lot of other states because people relocate.
Oh, yeah.
All the time. We've got 100 clients in Florida, people in Chicago, LA, all over the place.
I think one thing I'll say about you, professionally and personally, and a lot of people are a little scared, a little intimidated, but you put people at ease.
Right. Thank you.
And I think that's a wonderful quality
Right.
because you do put people at ease,
Right.
and we've referred several people to
Yes.
you, and they said, wow, yeah, I learned a lot. I sat with Arnie. Oh, I got a lot to think about.
Right.
And I think it relaxes people
Right.
because people, if they have not seen a financial advisor, it's a little intimidating.
Yes.
You know?
And for people who aren't used to it, some people say, well, they don't have enough money to need a financial
That's always
advisor.
what it is.
Yes.
Mhm.
And, some people do, but in our case, we don't have minimums.
Okay, that's important.
And
yeah.
But I think part of it is having the initial consultation, which we don't charge for, and get acquainted. Let's look at some of the numbers and come to an agreement between ourselves and the potential client and say, here's what I think or we think might be good for you. Then you can decide if you want to engage with us or not. So we don't charge for consultation. We got to figure out, do you need somebody like us at all?
Right.
And if you do, here's what we do. Do you like it or not like it? Here's how we charge, and let folks make up their own minds. But going through the arithmetic with us up front and going through sort of a planning discussion, and at least with some broad strokes, gives people a sense of whether or not they want to engage us or not. So they have the choice. They're not obligated to deal with us once we have an initial consultation. But a lot of times they do. Sometimes they don't, because sometimes maybe they don't need us,
Right.
Or the math is perfectly fine. But in most cases, we're somewhat helpful, whether they deal with us or not, kind of get them in the right pathway.
That's good
It's
to know.
amazing.
Yeah. Well, Arnie, it was great having you.
Thank you very much.
Yeah.
I appreciate being invited
Of
to
course,
chat with you
of
both.
course.
Yes, it was
very
great.
nice to be here
Always
this morning.
nice
I
to
hope
see
I've
ya.
been helpful to you folks and
Oh,
to
yeah.
the audience.
And we talk often, and you've helped several of our clients, and we appreciate it very much.
My
And,
pleasure.
So
Thank you
we'll
for having
continue
me.
with that. Yeah. And everybody, thanks for listening. Angela, thanks for showing up this morning.
Yeah, you're welcome.
No. We'll talk soon, and thanks again, Arnie and Angela, and thanks everybody for listening, and we'll see you all soon.